All right, just a small recap. This is the assumption sheet, obviously. And when we went through the assumption sheet, we tackled this part, and we tackled it quite often. Talking about how companies are evolving through the whole funnel from I do a pre-seed investment and happen to sell it on, I don't know, Series D or E or whatsoever, and kind of simulating how my equity ownership develops, how my shareholding develops, how the NAV develops over time, kind of to trial and error to see if my investment strategy based on my ticket size and my ownership and my entry point makes sense after all, and if companies have the capability to return my fund. So while me and David were discussing this and hey, this is actually very cool, it makes a lot of sense, but it's not dynamic. So how can we make like something rather dynamic out of it? And especially how can we create compare versions? So see the immediate impact between, hey, this is strategy A, this is strategy B, where's the delta? What is the delta resulting out of? So here again, I just wanted to show this to you so you know where this is linked to. And what we have done is we actually created a very dynamic solution. So literally what I've just showed in the Excel spreadsheet is this, but in a dynamic version. So let me run through it and really explain it line by line, what you can do with it, why you can use it, what you can use it for, and then we're going to do like a small exercise, and maybe it is helpful for you, like while you're thinking about your own model, while you think about fund returners, and kind of get to a better conclusion on how your investment strategy should look like after all. So really quickly, like you remember the model we've been running was based on a 50 million fund. So this is what I illustrated. You can play around with it and make it a 10 million fund or a 100 million fund, whatever works best for you. Then for simplicity reasons, I just said like, what's the overall fee structure? So fee structure here again, it's management fees, partnership expenses, and one-off expensive to actually create the fund. So you can type in whatever you think the cost base will be. And we always say it's ranging between 15 and maybe 25 or even 30% if you have a very tiny fund. And the result is you have a certain amount of a deployable capital, which you can see here. And then you can start playing around with it and say, how does my portfolio construction look like? And in practice, it's like, hey, how many pre-seed investments do I want to do? In this case, I created the default scenario. The default scenario is I do 20 pre-seed investments, 20 seed investments, and 10 Series A investments. So this obviously sums up to 50 companies, which is probably like an average portfolio, maybe a little bit bigger than people would expect. You by now probably know my opinion. Portfolio should be actually bigger in order to kind of maximize returns, or at least the likelihoods that you have a good, well-performing funds. So what I'm seeing in the market is probably rather anywhere in the ballpark between 30 and 40 companies. So you can just model this, change this to whatever makes sense to you. You see everything is dynamic and will change accordingly. Then the next bucket is thinking about, yeah, okay, I'm going to do pre-seed investment, seed investment, Series A investment. You can actually knock them off as well and say, I actually don't do any Series A investments. So it will be obviously limited then to pre-seed and seed. And then think about like, what's my average entry ticket size for these investments? And here again, you can change everything and you can see, if I'm investing too much with the amount of pre-seed investments, obviously I'm overcalling. So you probably have to correct it. So you immediately see a red flag when something is not working in the model. So let's go back to the setting. And in this case, I said, well, we're going to do 20 pre-seed investments with 250K checks. We do 20 seed investments with 750K checks. And we're going to do another 10 Series A investments with 1.5 million checks. So you can see the total sum of the investments, 35 million. And then I added follow-ons as well, which you can see in the next one. I can just make it very easy and say, I'm going to do a follow-on strategy or not. If I change the toggle, there's no follow-on strategy. If I change the toggle back to power law investing, so I do like a follow-on strategy, you have a new option saying I always double down. So if my entry ticket is 250K, my follow-on tickets will be 500K. So, and for pre-seed, for seed, it would be like 750K and 1.5 million accordingly. And for Series A investment would be then obviously the double of the Series A investment. So if you don't want to play around with it, you can just make it very simple. Nonetheless, you have to define how many follow-ons you will do. I do believe you have to have a wide, broad portfolio in order to have a picking pool which is sufficient in size so you can actually do meaningful and great follow-on investments. In this scenario, I decided, well, I think there's only going to be 6 follow-on investments. Might be not enough, but it doesn't change the model in itself because it's like thinking about fund returners in general. But you could do 6, 10, 12, whatever you think is best, whatever makes sense. And last but not least, you get a summary here as well on like your follow-on investments. You can go into round dynamics. That's where things become a little more funny and where you can like be a little creative and adopt everything to your actual needs. Here again, something we touched in the past, like a deep tech early stage fund behaves very differently than a biotech or like a pure software fund, or one which is focused on AI, as pre-money valuation, round sizes, step-ups between rounds changed, obviously. So what you can do here is then go into each and every single round, and I modeled it and say, hey, I think the round size in average in my world is 1 million, pre-money valuation is 6 million, so this sums up to 7 million, dilution is that. And you can do this for every round and kind of play around with it and just say, I believe it's going to be this or that. To simplify it and to simplify the whole thing so you don't have to do it by yourself manually, you can always say, what do I think is the step up between rounds from, as an example, pre-seed, 6 million pre, 7 million post, to the next round, I just put it's 2x, so he does the calculation by himself. You can as well say, no, I think in my case, it's rather 3x, and obviously everything will be changed dynamically. So here again, if you spend a couple of minutes to do a pre-setting, then you have like a raw model and you can start then playing and compare versions, which I will explain to you in a second how to do that. And last but not least, here again, you see the summary based on these assumptions and based on the model. There will be like a dilution of 75% from my first entry investment pre-seed, which is quite high, I must admit. So usually you would expect less. The later you invest, obviously, the less the dilution is and the more the remaining ownership is at the end.
So we've spent, what was it, total of 10 or 11 weeks so far, mostly in Excel, let's be fair. And it almost looks like now we're sharing a tool that does it all for you, right? So I think it's important we tackle that topic. And, you know, of course, Marc, inviting you to comment here, but the very brief version that I would share is I would see this more as an internal tool, what we're looking at right now, to help basically prepare the mindset to then develop the fund model. I don't know, Marc, do you want to just comment on that? Because I think it's a very fair question. Like, why should I build the model if I have this? This looks great. It's awesome.
It is a fair question. And I would ask the same question with honesty. So what this model does is only simulates fund returners. So even if you model a fund and say it's 30, 50, whatever million, and this is my strategy, it only focuses in the output on how am I creating fund returners? I'm going to explain this in a second. When am I creating them? And what's the likelihood and what is needed to get to these fund returners? So it's not a fully fledged model. It will not show you the actual evolution. Well, partially it does, but you couldn't use it on a day-to-day basis. Why we decided that it might be a good thing for you guys to kind of play around with is just like, hey, I have a strategy in mind. I think this works great. Then you can start modeling it. And sometimes it's just quite messy if you do it in Excel. And here you can do it very simple, very fast. It's always correct. That's a positive one. So there's no miscalculations because you did a typo or you like did a connection wrong in the Excel spreadsheet. And then you can start comparing them. So it's A, visual, B, it's easy, and C, it's quite fast to kind of pre-validate if you're thinking about your construction, the ticket sizes and the evolution from pre-seed to, I don't know, Series E makes sense in itself. And I will show you different scenarios where you could be simply wrong or where small tweaks in a model changes the outcome completely. So this is the purpose. Play around with it, think about your strategy, try to pre-validate it, and then use the information and put it in an Excel spreadsheet where you can work less dynamically maybe, but more accurate on your assumptions. So here again, it's a summary. Obviously, we have a 50 million fund, 40 million we end up deploying, 35 million is going to the entry investments. We decided it's a follow-on strategy as well. So 5 million is going to a follow-ons, summarizing it on a company level, 50 investments, 20 pre-seed, 20 seed, 10 Series A, and then 6 follow-ons. The average multiple I would need, average between pre-seed, seed, and Series A, obviously, in order to return my fund is 62.5x. In order to 3x my fund, I would need almost 200x. So just like here again, like sanity checking what you do there. And what is the best returner in my scenario? What does it mean? What is the best returner? A, it's a blended number between entry investment and follow-on investment. And B, this number can refer to either pre-seed, seed, or Series A. That's why it says the best returner from all possible constellations you're having. And then what you can see here, and that's why I'm saying it's visual, you can just compare all stages. Yeah, you can see, you see two lines. It should be three, which you can see here. It's green, purple, and blue, but one is overlapping with the others because of the presetting I'm having. So you would say, hey, where are like my companies? How are they evolving through the funnel? You can isolate this and I say, I just want to see and compare pre-seed investments. If I do a entry investment or like and a follow-on or no follow-on, what's the outcome at the end of the day based on my presettings? Then you can see an allocation overview saying like, how much do I allocate by stage, pre-seed, seed, series A, and what's entry, what's follow-on, and once unallocated, if I would just like not invest enough or have like uncalled capital, you would see it here as well. And then you can go into like, how would return multiples by exit look like based here again on my assumptions, saying if this company I invested in pre-seed ends up being sold in seed, what would be the outcome based on the multiples I'm expecting, the markups I'm expecting, and so on. So you get a quick and very good view about how your portfolio based on a singular investment would perform. The one thing I like most is the heat map, which will show you, and here again, this will be more clear when I show you different scenarios, like where do I actually create fund returners, like at what point and what time. As you can see here, if I do a pre-seed investment and this will be sold in Series B, I only return 0.1x of my fund. Here again, going back, well, yes, of course, if I do a 250K check out of a 50 million fund, obviously like a single exit in Series B will not be meaningful. And even if you would play it until Series E, it's only half of your fund. And I show you something, obviously, if you double this, and do 500K checks instead of 250, you already get closer to reality that you can create a fund returner in pre-seed investments in Series E. But you will overdraw. So you have to adopt other metrics in order to get back to the realities, like how much can I actually deploy and how does it work? Going back into the presetting. Exactly. So this is a dynamic overview on where do I create fund returner, how early do I create them, and what's the actual outcome based on my settings. And then you have like the complete round dynamics of the whole portfolio saying, okay, I have a certain amount of pre-seed investments. This is my pre-money valuation, post-money valuation round size. And I can actually see the evolution because for some people, for me as well, the numeric part here is confusing. That's why you're like, okay, I do these changes. And here you can do like sanity checking saying, does it make sense? Does it look like it's good or bad? And is it in line with what I'm seeing in the market? Then at the end of the day, you can actually see the NAV evolution by entry stage. So how would this actually look like if I do a pre-seed investment with follow-on, without follow-on? Where's the NAV going by stage? And when can I expect which kind of returns, or actually NAVs or DPI, if you actually sell these companies over time? So this is literally summarizing, same for the MOIC level, everything you have done in a more numeric part, so you can start comparing them just line by line or like next to each other. Even though it looks a little complex, if you just model whatever you have on the left-hand side, you can start playing around with it. And that's where I think it becomes cool. And here again, so quick, even though I'm repeating myself, like you have the input parameters, you have the output parameters, and then you have the third layer, which is like what you can do with it. So you can create a scenario for yourself and then just save it as a default scenario. So this is the basic scenario you're working with. Then you can create an alternative scenario and saying, I start tweaking around my ticket sizes, or I don't do follow-ons, and then the first default model, I decide to do follow-ons. Or you play around with round sizes only, or you play around with pre-money valuations only. Or you do a combination out of, I'd like this more than that, let me see what the outcome is. Or you only kind of play around with the portfolio size, so the construction part. So you decide whatever you think is relevant for you, and then you start comparing. And what you end up with is different scenarios. So as you can see here, we have the default scenario, which is always there. I created a second scenario, exactly with everything the same as you can see here. I just decided to do higher pre-seed tickets. And as you can see here, obviously the average multiple is changing, the best returner is changing, but moreover, I did this already before, real quick, the likelihood, or not the likelihood, but from a mathematical point of view, I could create a fund returner with a pre-seed investment and a follow-on by Series E. I could literally return the fund. And it's an interesting finding, especially if I go back to the default scenario where I say, on that scenario, I couldn't, because it's mathematically not possible unless obviously there's a strong deviation from my assumptions into reality. I created other scenarios instead of doing follow-ons, even though the allocation is fairly small in the default model, only 5 million. I created the same model with no follow-ons. I put more money into my entry tickets. So what happened is, obviously, the numbers change for everything you can see here. You play around with it and then you say, hey, this makes sense, it doesn't make sense, or maybe I should work with this and that, and change certain other things. I created a scenario for the step-ups. As you remember, in the very end, you can create an overview saying the step-up between pre-seed and seed is 2x, 3x, 4x, and I moved it just to 2.5x from 2x. And what you will see is, oh wow, by Series E, I don't create fund returners, but this will return my fund 1.7 times. Just by changing the assumption here that the step-ups between my rounds are bigger. And you will see this on a singular basis, that you do a 5 million pre-seed investment, or like 5 million pre-money valuation pre-seed investment, and then you jump to 15 or 20 million in the seed round. And this makes a massive impact, obviously, as the step-ups thereafter grow. A small change in my assumptions led to a delta of almost like I can create more than 1x of my fund. I think this is the beautiful part about like doing these quick scenarios, saying, if I isolate one variable and just change it, what is the impact on fund returner, on NAVs, on MOICs, and so on, which you can see then obviously all visualized here, right? As I showed before. I created another scenario where I say I doubled down on my follow-on reserve, which you can see here. I moved it from 5 million to 10 million and reduced my entry ticket. What does it mean? Obviously, well, it's getting a little bit better, but it's not getting much better, in full honesty, as you have smaller entry checks. In this case, I carved out money from the Series A and put more into follow-ons. So for pre-seed, it looks better. For seed, it looks better. For Series A, it's still not getting me to the point where I can actually return my fund. Then I created a scenario here. Again, I'm just doing examples so you know what you can do with it. Where I say I have a compressed portfolio, and it's actually not compressed, it's 35 companies, but before it was 50. But if I take all same assumptions, what I obviously have to change is the ticket sizes are going up. And if the ticket sizes are going up, obviously my return profile goes up. And I can all of a sudden create fund returners in Series E's, in my pre-seed investments, in my seed investments, and my Series A investment. So I'm getting closer to hey, cool. If I have an entry and follow-on strategy with these ticket sizes, by Series E, with my assumptions, all of them could create fund returners, including my follow-on strategy. So this is something you actually want to have as a finding. On the counter side, what you don't want to have as a finding, that in all layers, pre-seed, seed, Series A investment, you can create fund returners based on your assumptions. So your ticket sizes are wrong, or your assumptions on the step-ups are wrong, or the round sizes are too big, or like the valuations are like maybe not right. This should help you model early, like with your assumptions, before you actually build your Excel spreadsheet. And getting back to this layer, then you can actually start with thinking about compare versions. So you can open it and say, I have my default scenario. This is the first thing I want to compare. And I want to compare it with different step-ups between rounds. Everything stays the same. I just change the step-ups between rounds from pre-seed to seed and so on. So I can start a compare version and see where the deltas, what is changing. Yeah. And there's a calculation mistake, so let me have a look at this. And by doing that, you can actually see what's the impact of these small changes in the overall numbers. And this will, here again, help you to understand what you should do differently in order to get to something which you can then defend when you speak to investors or like use it for internal purposes. The export function you can ignore. It just like literally exports the number, so it doesn't look as nice as it looks here. If I can fix it, you can even export it and then have it as a PDF and say, hey, cool, this is how it would look like, and then you can share it with people or whatsoever. As David said, like what we can do is we can think about like a hypothetical fund and maybe change some numbers and see the impact and try to find the right interpretation on why these numbers are the way they are and compare them to each other. We can as well not do that, so I'm fine with both. And we just work on sharing the model with you guys, and you play around with it and like crunch in your own models, work with it, give us feedback if there's a bug in there. So if that should be the case, we're very sorry. And we fix it then, obviously. And that's why we decided to like have like no PowerPoint or something today. Just show you the model, show you how it works, and show you exactly how you can use it for your own purposes and have like an advantage out of it.
I think it's very important that we also highlight what this cannot do. You know, I've been saying this this whole session, but you know, I think it's really important we're super transparent there, right? Based on what you were saying, Mark, like you were talking, you gave a couple of examples or you hinted to it, like you hinted to this idea of, you know, diversification, right? So changing the size of the portfolio, right? Of course, this doesn't account for it. So it also always is assuming like the best case scenario, because again, we're going back to like, what is a fund returner? How do we find a fund returner? Something I also took a note here is like, if you have a strategy, and this is something, Mark, you actually mentioned in, I think it was one of the first or second masterclasses. If you go for an approach where you want to generate early liquidity, right? This does not reflect that in any way or form, because you know this is just, again, fund returners. Would you do, Mark, any caveats, that things that are important people bear in mind when using this tool that it cannot do and it's not designed for?
I give you a very honest question. I tried to replicate my model, which I use, into something as dynamic as this in Lovable. Didn't work. I couldn't get it. I tried and it's like, okay, some things were working, some things were not working, but it was just overwhelming for Lovable. Maybe it was the issue. I didn't try it yet in Claude. Maybe I'm going to do it as an exercise for myself. Maybe it's better with handling so many assumptions, and then don't do mistakes, especially in the calculations, because here again, the devil is in the detail. If you have a minor deviation or minor bug, the whole model doesn't work. It just like it implodes. It's not going to help you. And even though I tried for quite a while, I didn't get it done. That's why we said, like when we thought about like, but still some aspects were working quite well. And we showed like another one with the Monte Carlo simulation that worked perfectly well. So if you isolate certain exercises from your fund model into Lovable or Claude, it does work. It is cool. But like having a fully combined, fully fledged model, it didn't. I even thought about like, okay, maybe I work with certain spreadsheets. So you have one solution, one for the fund returner, one for the construction, one for the decomposition. Couldn't merge it into the assumption sheet. It's so hard to then connect it again. Maybe it does work, but it would take quite some effort and time, and then it would be still buggy. So here again, what's important is like, this is a simulation only for fund returners. It doesn't do anything else. Even though it visualizes certain things and shows you the allocation strategy and you can play around with your construction, this is obviously the basis. But the only purpose is, does my investment thesis and investment strategy make sense? And does it bring the potential to return my fund based on my core assumptions? And I tried here again to simplify them. No graduation rate as an example, because they wouldn't be relevant. You could put them, yeah, cool, but it wouldn't have an impact on the outcome, because the assumption is always pre-seed valuation, seed valuation, Series A valuation, round sizes, dilution accordingly, and how much money do I have in a fund? How much money could I invest based on my construction strategy? That's why I added this component to add this extra sweet sauce of reality, because you could model whatever you want. If it's not in the context of your fund, it doesn't make sense because you couldn't replicate it. Therefore, you need this pillar of my fund would look like this. And now I isolate and say, how would a single company in my pre-seed strategy, seed strategy, Series A strategy look like if I add follow-ons, no follow-ons, or like the other assumptions?